Friends, the part one of this session, we already discussed about the infrastructure financing and the various facilities, various schemes available for financing the infrastructure projects. Now here, this now entire topics would be we are dealing with infrastructure only, but it's another facility that is available to the infrastructure is that is of partial credit enhancement to corporate bonds. As you know, the infrastructure that requires huge outlay, the funds outlay in infrastructure, any infrastructure project would be on very high. And how to meet the infrastructure, this outlay, how to meet the requirement? We can say that the bond issue would be the corporate bond issue would be the ideal. There is an ideal means of raising these resources. How it can be? Now, any infrastructure project in the initial stage, they will face a lot of problems. As I told you, the infrastructure project is having this one distinct feature. That is, one of the features is there is a maturity problem. Because of the maturity problem, maturity mismatch, that is creating the problem. Long tenor loans should be provided. So that every banks cannot provide all these things. So in that case, the infrastructure lending, infrastructure financing, the project will go for corporate bonds, issuance of the corporate bonds. This can be issued because this can be issued by the infrastructure project to meet the outlay, meet the requirement of the infrastructure project. See, bond issue, we can say that the bond market, corporate bond market in India is still in the nascent stage. So far as the corporate bond market in India is still in the nascent stage, so far as corporate bonds are concerned. So naturally, there is an excessive pressure on banking sector for financing, else the project could not take off. So, but banks financing will come, then there is a liquidity risk because of the liquidity mismatch. Liquidity mismatch, then liquidity risk would be there. So, how to overcome this risk? So, even see the units, the financial institutions which have long-term resources, say for example insurance, provident fund, pension funds, etc. Their liability would be long-term. So they are the ideal sources by which this bond issue can be subscribed to. But these institutions require high rating. Bond issue in their particular minimum rating should be there, else they cannot involve in the bond issue, or they cannot involve in financing also. So that in order to overcome this problem, in order to overcome this or enhancement in the credit rating, if the credit rating, so far as the infrastructure units in the initial stage, rating may not be so satisfactory or so good to take care of the requirement of the long-term lenders, that is insurance, provident fund, and pension funds. So the enhancement of the credit rating of the bonds by the corporate, RBI has permitted the banks to consider this partial credit enhancement to corporate bonds. This is the partial credit enhancement to the corporate bonds is by way of this we can say that non-fund based facility to non-fund based subordinated facility of an irrevocable contingent line of credit. You may be knowing what is a line of credit. That it is a non-fund based one. There is a subordinated facility of an irrevocable. It is irrevocable. Please remember, it is an irrevocable line of credit. What is the purpose? This line of credit would take care of any shortfall in the cash flows in the servicing of the bonds. To take care of the cash flows in servicing the bonds, thereby the rating would improve. And rating would improve, and they are in a position to raise the adequate funds. They are in a position to get the bonds subscribed by the long-term resources. Okay, what are so RBI's so the main crux, the main objective of this issuance of this PC is, we can call it as PC, partial credit enhancement to corporate bonds by the bank, is to enhancement or the improvement in the rating of the bond issue by the infrastructure project. Is it clear? Now we go ahead with what are the RBI directions or RBI directions for issuance. RBI permits the banks to issue PCs to the corporate bonds, but at the same time with covenant that there are certain stipulations. What are the stipulations? What are the conditions? The first and foremost one is there is a cap. The cap is fixed so far as aggregate exposure from the banking system as well as individual this one. So far as aggregate exposure from the banking system not to exceed 50% of the bond size of the 50% of the bond issue size. Bond issue size 50, it should not exceed 50% so far as from the entire banking system. And so far as individual banks, it is capped at 20% of the bond issue size. So 50 and 20 in respect of the banking system and individual banks respectively, so far as exposure is concerned, aggregate exposure. Second one is PCE should be issued at the time of issuance of the bond. That is, it should be provided at the time of the issuance, and that too, as I told, it is irrevocable. Once it is issued, it cannot be revoked, it cannot be amended, it cannot be modified. It is irrevocable. Then this is for, and there is another condition so far as a lender issuing a bank is concerned. The pre-enhancement of the rating prior to the issuance, the rating must be at least BBB minus or better rating, or better any rating. So minimum is BBB minus or any or better. Better is always good. The minimum should be BBB minus. Then banks cannot, and another condition given to the bank cannot issue PCE, that is partial credit enhancement, by way of guarantees. Guarantee is bank issues various guarantees, but this is not a guarantee. As I told you, it's an irrevocable contingent line of credit. So this is not a guarantee. The banks cannot issue these guarantees in place of PCE. Another condition to the imposed on the banks are banks cannot subscribe to the bond issue, participate in the bond issue, except bank can give finance for the issue, but no, the issuer cannot subscribe to the bond issue, or they cannot invest in these bonds. And every bank, the bank who is issuing this PCE, they should have always a duly approved policy in place. Duly approved in the sense by their competent authority board. So that these are the conditions, and in addition, and their operational aspect, the drawings, as and this when any shortfall comes, then only this should be drawn. It's a non-fund based facility, supplementary facility. So whenever any shortfall comes, it can be drawn. So whatever is drawn is to be shown as an advance, and whatever is undrawn, it is a contingent liability so far in the books of the bank. Advance, that is drawn portion, that is fund based over here. Then undrawn portion, there is a contingent liability like guarantees and other thing issued. Then project must be, and another the precondition, that is RBI gives the permission to the banks. Any project, that is, as I said in the part 1, I said project must be technically feasible, financially viable and bankable. So it must be the robust one and viable project. and the normal care should be taken, proper due diligence, proper appraisal, everything should be taken. And these are the things. And unpaid interest, while further drawings, any unpaid interest on the drawn amount, that can be excluded while making the further drawings. And always banks are required to give the partial credit enhancement full honor full PCA commitments made from the beginning itself. They will have to give full, but with the net of not net of, but interest can be excluded. Interest whatever incurred or accrued can be excluded, and the full amount can be given wherever required. Then banks are a bank, and bank is priority so far as concerned. It will come in the last stage after meeting all this one. All the creditors should be met, then only this PCE would be taken care of. So bankers are normally bankers will arrange for a ring-faced escrow mechanism. The ring-faced escrow mechanism means whereby the proper apportioning can be made from the cash accruals or the generation of the funds. So escrow mechanism for cash flows under the bond trustee arrangement should be made. Then contingent facility may be made available as a revolving facility. Once it is paid off, then it can be considered as it's not necessary that it should be. It can be considered as a revolving facility. So these are the guidelines so far as issuance of the partial credit enhancement is concerned. Credit enhancement to the corporate bonds. Now coming to another topic, that is how we can finance. In an infrastructure project, there are chances likely that there may be cost overruns. Cost overruns may be envisaged in the initial stage itself. Sometimes it may be later on it has come. So what way it can be financed? Financing on the cost of overrun. Banks are permitted to finance a cost overrun provided they are subject to certain conditions. And banks can consider if that is already envisaged prior to the financial closure. If it is already there envisaged in the project itself, cost overrun, that can be financed by the banks by a standby credit facility. SCF, standby credit facility, it can be financed at the time of initial financial closure. And that will have a bearing on, or that will be factored. This standby means SCF, we can say that standby credit facility, that should be factored while drawing this various ratios, debt equity ratio, DSCR, and fixed asset coverage ratio, FICR, etc. drawn. These facilities should be taken accordingly. The important ratios, all ratios are drawn after taking into account this facility also. And HCF ranks pari passu charge with base project, along with other outstanding. Our exposure, it should be taken into, so far as it should be taken for the exposure purpose as well as for the repayment, fixing the repayment schedule. And cost overrun, there is one option that it is already envisaged, and the second one comes to the cost overrun not envisaged at all. That in that case, the cost overrun, it may be due to the DCCO, that is a date of commencement of the commercial operation. Once the commercial operation takes place, then only the generation of the income. It can, if it is due to the delay taking place, commencement of the date of DCCO, the date of commencement of the commercial operation, in case of infrastructure project by 2 years, and for non-infrastructure project by 1 year respectively, in that case it can be financed by the banks also. But these facilities cannot be taken, it need not be treated as a restructured one. It is an ordinary, these 2 years and 1 year, 1 year in case of infrastructure, 2 years, and other this 1 year, that can be considered. But subject to certain, there are also some conditions. First, here the conditions is suppose IDC. That's in the case of implementation during, that's interest during implementing IDC, comments interest during commissioning. IDC in that case, that can be financed. That can be financed separately. Okay. Interest during construction we can take it, or interest during construction. Any interest factor is because drawings are taking place, so naturally the interest will be loaded. So that interest is not envisaged, it can be financed or it can be capitalized also. So it can be financed. In addition, then other cost overruns. The condition this is one IDC can be taken out of this, taken separately and financed, or it can be capitalized provided it is already there in the project design. Now, second one is another criteria is condition is that the cost overrun should not exceed 10% of the original cost of the project. IDC means excluding IDC. IDC is taken out, that can be separately dealt with, but the cost overrun should not exceed 10% of the original project. Then here the debt equity ratio, even after considering this one, because this was not a financial closure time, it was not very subsequent to that one. In that case, the debt equity ratio should not undergo any change, and DSCR should be at the acceptable level. Any change would be there, is okay, but it should be within the acceptable level of the bankers, lenders. The another condition is that whatever be the cost overrun, that promoter's contribution, it should be brought upfront. Else, once you part with this money, sometimes there will be some laxity on the part of promoters to bring in. So that should be there. It should be brought in upfront. Then only further drawing should be considered towards this cost overrun. Then the ceiling of the 10% should be inclusive. Suppose any foreign capital investment and all. So any exchange fluctuations vis-a-vis the Indian rupee vis-a-vis the foreign currency, exchange fluctuation. These exchange fluctuations should be factored in the cost overruns, and everything taken together, it should not exceed 10% of the total cost of the funds. That is what the ceiling of 10% of the original project cost is applicable for cost overruns, even on account of the fluctuations in value of INR, Indian rupee, due to extension of the date of commencement of commercial operations. These are the conditions to be fulfilled for financing the cost overruns. So we have seen cost overruns already envisaged in the project cost, that is before the financial closure, that can be financed by the SCF, then says standby credit facility. And what are the conditions relevant to that? But here the second one is after the financial closure, if the cost overrun is there, other than IDC, that interest during construction, other than IDC, can be financed by the bank subject to certain conditions. We have dealt with the conditions, that is inclusive conditions, that is IDC out of this one, out of the cost overrun, then minimum 10%, it should not exceed beyond, it should not go beyond 10% of the cost of the total original cost, not cost of the fund, original cost of the fund. And debt equity ratio should be, there should not undergo any change, and DSCR should be at the acceptable level, and promoted share should be brought in upfront, and all other terms of the original sanction should remain unchanged. But this 10% should also contain, would be part of the any exchange fluctuation difference is there, that should be taken care within the 10% only. Okay, with this we will conclude this session. We have dealt with infrastructure financing, we have dealt with partial credit enhancement, we have dealt with how to finance the cost overruns. I trust that this would be, you will get the fair idea about the various topics we have so far dealt with. Thank you very much.